welcome to the first annual forum of the Jacobs-Levy Equity Management Center for Quantitative Financial Research.
It's the mission of the Jacobs-Levy Center to integrate the many disciplines contributing to the field of quantitative finance.
We think in this paper that carry is an important characteristic of securities that can be directly observable. It predicts returns in every asset class we look at, and we look really across all the major asset classes around the world. And so that provides a broad rejection of the uncurved interest rate parity and its generalized versions. It shows that expected returns vary across assets and is predicted by carry.
We look at asset pricing in the dark. We look at inefficient, illiquid stock markets. These are large. There are lots of these stocks. They're very thinly traded, and they're interesting precisely because they're very different from the listed stock universe. They're extremely poorly and thinly held and thinly traded. We see very few institutions in this market, and it's very hard to short. So those are all interesting features. The bottom line, though, is that these are markets where these return premiums, especially for illiquidity, are large. And if you're really smart and very clever about trading in these markets to lower transactions costs, then these are markets, because there's very little information there, these are markets where you can make a killing.
We offer an explanation for the negative relation between expected return and I-vol, which combines arbitrage risk and arbitrage asymmetry. The I-vol effect is negative among the overpriced stocks, positive among the underpriced. First of those is stronger, so we get the overall negative effect, and we also get time variation in this effect that's consistent with this mispricing and asymmetry story.
Starting a company is not an easy task, and entrepreneurs must be passionate about their goals and committed to their goals. And Bruce and Ken have been dedicated to the success of their business. The positive results of their perseverance shows through. Please join me in welcoming Bruce Jacobs and Ken Levy.
First, we'll discuss an overview, which includes talking about the unique risks of leverage. We'll talk about the conventional approach, which is the mean variance model, and we'll consider the conventional approach using constraints on leverage to control the amount of leverage that's in the portfolio. Then we'll talk about our proposed approach, which is the mean variance leverage model. And what we'll do is evaluate portfolios for investors who are averse to leverage, and we'll also optimize portfolios for investors who are averse to leverage. The question is, what is the optimal level for that leverage constraint? An alternative method is to introduce a third dimension to portfolio theory and practice, which would be introducing a leverage aversion term. This results in the mean variance leverage optimization model. Now let's take the case where your leverage tolerance is 0. Here, you don't want any leverage. So all the portfolios along this x-axis would be long-only portfolios. Again, no enhancement, that is, there's no leverage that's present. Also, to assist you in reading this chart, perhaps it's worthwhile giving an example. So if your volatility tolerance is 2 and your leverage tolerance is 2, the question is, well, where would be your enhancement? It would be up in this corner, right here, a little above 50%.
Bruce showed an example where the optimal enhancement was 29%. If we use other examples with other samples of stock, other aversion parameters, you get a different number as being optimal for the enhancement. And unless you happen to guess that number and set the constraint at that number, the solution will not be optimal with mean variance. The key is to make the optimal trade-off between volatility risk and leverage risk. Thank you.
It seems to me that you are not penalizing, the investor preference, usually there's aversion to higher moments. So here, I don't think you have aversion to skewness, because leverage is kind of, you're saying leverage is bad when you introduce that constraint on both sides. So whether it's good market or turbulent market, you seem to be penalizing by the same amount, whereas there are other, as you probably know, utility functions that actually address both sort of skewness and kurtosis. Here, I think you're addressing kurtosis, but not the skewness.
Well, you know, Harry might be one who would want to address that, as he has a new book out that deals with issues like that. That actually, you don't need normality in order to have mean variance as the appropriate formulation. All you need is a concave utility function. Harry, did you have some words?
The introduction to my new book says it's trying to clarify that our field is subject to what I call the great confusion, capital G, capital C. That's the confusion between the necessary and sufficient conditions for using mean variance.
It's quite an honor for me to be introducing a man who needs no introduction. Harry Markowitz published what was to become, according to the late Peter Bernstein, quote, the most famous insight in the history of modern finance. That would be modern portfolio theory, or the concept of portfolio diversification, the basis of Harry's 1990 Nobel Prize in Economics. We believe that your achievements in the field of retirement planning rank alongside your other achievements, and we're pleased to be honoring you with this award.
No one can doubt the contributions Harry Markowitz has made to both theory and practice. As the father of modern portfolio theory and the inventor of SimScript. How fitting that the first Wharton-Jacobs Levy Prize goes to a man of such distinction and impact. Thank you, Harry, and congratulations.
Oh, wow. Oh, wow. Oh, yes, a look in the product. This is gorgeous, isn't it? Thank you so much. Thank you.